Hello, this is Christian from Ronald Gelok Associates with some interesting news about everybody's favorite topic, taxes. I know. But are you aware that there are little known taxes which can affect your retirement? Now, very often these taxes are not even on your radar. That's why we call them stealth taxes. They simply sneak up on you, and many of these stealth taxes do not even come into effect until you're 65 years or older. Just some of these taxes you might be paying are Social Security benefits tax, Medicare premium surtax, the alternative minimum tax or AMT, or even a 3.8% net investment income tax. Now, our new federal tax law benefited some people and hurt others. For some, the simplified tax brackets and higher standard deduction of $12,000 may save them money on their income taxes. For others, the elimination of personal exemptions and many itemized expense deductions, certain investment deductions, state income tax deductions, and limits on property tax deductions have caused some financial pains. For those of you with a high mortgage, the limitation on interest rate deductions may also be detrimental to your wallet or pocketbook, even with the higher standard deduction. By far, though, some of the most tax vulnerable of all of our assets are retirement funds, such as 401ks, IRAs, 457s, 403bs, and other tax-qualified deferred plans. Now, we really don't know the full extent which the government will try to further tap into these retirement funds. One idea that has been heavily thought about for some time now is the elimination of the Stretch Out IRA. While we currently can still take advantage of the Stretch Out IRA, there are also several bills in play that would change or even eliminate all of that. Some of the possible changes are income tax on your qualified holdings would be due immediately upon death. Heirs can defer income tax for 5 years, after which the distribution must be made in full. Heirs can defer up to $460,000 and the rest taxed over a 5-year period. Perhaps even more significant than income taxes at death are income taxes during retirement. When you reach 70 and a half, you are required to take a minimum distribution, or RMD, from your tax deferred plans. Now, this distribution increases every year as assets grow. It is calculated on the amount of qualified assets, or in layman's terms, taxable assets that you have on December 31st of each year. Now, if you fail to take the distribution, you will receive a 50% penalty on the amount you were supposed to withdraw, and you still owe the taxes on the same exact amount whenever you decide to withdraw it. So, for example, if you had $250,000 in your qualified retirement accounts and you're about 71 years old, your estimated RMD would be just around $9,433. If you fail to take that distribution, you would be penalized by the government and owe them around $4,716. And if you decided to take that $9,433 later, you would still owe income taxes on the total amount, even if you already paid the penalty. Now, these distributions can also affect the taxation of Social Security. Prior to 1984, Social Security benefits used to be 100% tax-free. 1984, this was changed up to 50% of your Social Security benefits, depending on other income you might have. And in 1993, this was changed yet again to 85%. The income threshold for single taxpayers is over $34,000 a year, and for couples, just over $44,000 a year. Now, the tax law passed in 2017 left out many proposals. A few examples of what was left out are the lowering of the limit of the maximum contributions you can put into your tax-deferred retirement accounts, requiring that the retirement accounts act like a Roth IRA by disallowing any deductions you do for contributions, but allows for growth to remain tax-free. Also, removing the tax cap for dividend income and long-term capital gains, which is a problem for every investor. Disallowing owners of second homes and vacation homes to take deductions on mortgages and property tax. And requiring investors to use their lowest tax basis in calculating capital gains for both stocks and mutual funds. Now, we don't know if any of these or other suggestions will still pass. What we do know is that taxation is dynamic, and we need to be quick and agile if we're going to do any realistic planning. Now, if you would like an analysis on how these stealth taxes could impact your spendable dollars and learn some advanced solutions and strategies, take advantage of our free 30-minute financial assessment. You can have an online conversation with a member of our team via video. You can have a phone conversation with them, or we can schedule you in for a visit into one of our closest offices in New Jersey or Florida for an in-depth analysis. I know, taxes is an interesting topic, right? But again, my name is Christian with Ronald Gelok Associates, and you have a wonderful day.